Thank you.
It's working. Hello.
Yes. You guys in the next room? Oh my God, 5.
Yeah, so I'm very okay. I will bring you to
I don't know.
Yeah. Okay, sounds good. All right, nice.
Free to bring it in. All right. Okay. My name is Marty Guay, VP Business Development, Stanley Black & Decker, and I am the moderator today for the Considering the Models for Funding and Support. So we've got a very good panel. We're running one low. But what I'm going to do is I'm going to let each of the panelists introduce themselves, and then we'll kick into a spirited discussion around this topic. Thanks, everyone, for being here.
Hey, thanks so much. Hi, I'm Mark Josephson. I'm the founder of a company called Cast Iron, which I'm delighted to talk about. I'm a lifelong entrepreneur, 25 plus years building technology and internet businesses in and around New York City. I'm the son of entrepreneurs and always knew I'd be working for myself no matter who was signing the checks. I have raised venture, I've raised with studio, I've sold to private equity, been CEO 3 times, first-time founder, and just thrilled to be here today. Lots to talk about, I'm sure.
That's amazing. So I'm Jennifer Jordan. I'm an early-stage investor, seed Series A for a fund called iGlobe Partners, where we invest in global game changers. I was not a serial entrepreneur. I was a hippy-dippy person at Reed College who fell into investment banking when I got frustrated with the not-for-profit world, and I wanted to be in a place where we were constantly creating and figuring out how to capture value. And I spent the early part of my career in investment banking. Then I ran investor relations for a publicly traded software company. And then I went back to my true love, which was working with companies from like the 0 to 30 million. So back to venture. And I worked for the state of Massachusetts VC fund, ran 2 programs for Techstars, and now I'm at iGlobe.
Hi, my name's Matt Wilkins. I am a partner with Fuel Venture Capital, a Miami-based venture capital firm with 500 million plus under management. I head our regional headquarters in Abu Dhabi. My background is I was worked on Wall Street for 16 years. I was a trader at Goldman and in interest rates, and then got into private equity real estate, Hollywood film financing, and eventually into venture capital. But excited to be here on this panel with all of you.
Still working.
Hello, everyone. I'm Miles Lasater, co-founder and CEO of Purpose Built Ventures. We're a venture studio that works with pre-product entrepreneurs to create companies from scratch that help provide economic opportunity to their customers. Background is a serial founder, 2 companies here in New Haven, one from dorm to IPO. And Mark, my co-founder, and Casey, co-worker there in the audience, so they can keep me honest. And also C-Click Fix here, and I've been a VC and a Kauffman Fellow.
Thanks, Miles. Miles, why don't we start with you, since you have the mic. Tell us about what are the big lessons you've learned as a founder, bringing your ventures up all the way through IPO. What are the things that stand out for you? What are the lessons learned that you didn't know going in, but looking back, are real foundational and inform others in the room what that journey looks like?
One of the things that I learn over and over again is focus on demand, focus on customers as early as possible. There's a lot of other logistical details that come up and questions you have, but if you don't have a customer you don't have a business, so start there and keep returning back. Certainly feel like when you start a venture, if you really knew how hard it was going to be, you might not have done it. You know, it's a cliche, but you definitely feel that sometimes. And for me also, there was a sense of kind of peeling an onion of commitment. I would think I was committed, and then I would reach a new level of, oh wait, now I'm willing to do such and such more. And there's more to give in terms of I was holding back certain contacts, or I was, not willing to really sell as passionately, or, I thought X, Y, or Z tactic was off the table, even though it wasn't illegal, it wasn't immoral. Why wasn't I willing to do that? And so this sort of your level of commitment escalating over time is a fascinating experience as a founder, and look for it, see where you're holding yourself back, and see where you can lean in more.
Jennifer, could you follow up on that? You've had experience with Mass Ventures and Techstars accelerators and seeing founders in the valley of death. And I don't know if Miles had to harvest a kidney or anything like that, but
Yeah, I think
people trying to fundraise.
One of the things that, since I've sort of been on the investing side from like Napkin through IPO, the thing that's interesting to me about what you said is that place of realizing not holding yourself back. And the most successful founders that I've met along the way have this way of being fearless. And it's a certain fearlessness. It doesn't mean you're without fear, but it means that you're so passionate about getting this thing done that you're willing to ask for the help you need almost before you need it. You're willing to ask in the highest place for the best absolute help you can find, right? And so it's like you're fearless to make that call and reach out. And I think that's a really challenging place to be, especially if you've come from being a technical founder, or as a woman founder for myself, you've been raised to like always come with all the dotted I's and crossed T's and be held to account in a certain way. And you really have to step out of that place. So that's my follow-up. Be fearless.
Can I add on?
And then Keenan, we're going to get to you, but we're going to stop at Matt on the way back.
I think that there's no right way to build a company from zero. There's just your way that you're doing it. I would add, not replace what Miles said about focusing on the customer, because you have to. If you don't have any customers, you can't sell anything. You don't sell anything, you don't make any money. But also, it's got to be a problem that you are passionate about solving, because the little things that you're going to have to do every single day have to ladder up to something you actually care about and that you can't stop thinking about. There are no shortage of good ideas out there. There's plenty. But it's the connection that you have to solving that problem that's going to get you through those days and get you to start to give more and to get to, peel back that onion a bit more, I think.
Matt, for you, if you could talk about specifically in the fundraising area and really the challenges of, you've had exceptional experience in a whole lot of organizations, and, you had to have those long days and nights where things weren't working out well. And how did you keep yourself kind of centered and kind of keep the feet moving and the chin up?
Yeah, and I should add that right now is probably arguably the hardest fundraising environment in over 15, maybe 20 years, particularly for private equity and venture capital. So with that, obviously it's going to be hard for startups to get cash. There is a lot of dry powder out there with these funds, but how they allocate it is another question. For us in particular, being a Miami-based VC, we kind of fall in this different category because we're not a traditional Silicon Valley-based VC. We're not a New England-based VC. So we have to work a little bit harder to find that cash to basically, invest in the entrepreneurial ecosystem across the world. We do have a global footprint. That's part of the reason that we opened up a regional headquarters in the Middle East. The Middle East being one of the locations where everyone's going to get cash. But the irony out there is that it's a relationship-driven region, and so it takes years upon years to try and raise money out of that place. What we're finding where the low-hanging fruit for us is being a Miami-based firm is Latin America. Because of the geopolitical discourse that's going on down there, there's a lot of families that want to move their capital up north, and Miami is one of those de facto financial hubs for them. So we found that our ability to raise capital out of the South American continent is much easier than it is to get capital out of Europe or the Middle East or Asia. The United States still has a number of people looking to deploy. Right now, these current vintages, 2023, 2024, are probably going to be some of the best vintages over the last 10, 15 years. And the reason for that is that a lot of these valuations now are coming back to their means. There's been this inflated market of valuations that we've seen. And now as they come in, there's still great companies out there. I'm sure there's a number of them in this room. And we are looking to invest in those companies. But what's happened is the investor now has a little bit more stronger power than they did years ago when the founders could control and dictate the flow of the terms. So you will, for those that are looking to raise capital right now for their startups, you will find that you might have to be a little bit more flexible trying to grab that cash, but there will be capital for you if you're a good company. And so for us, as we raise that capital, we have a rolling situation where we'd like to be an active investor. We will basically bring cash in and then deploy it as quickly as possible. So right now we're raising $300 million. Of that, we've probably raised around 100, and we've deployed much of that 100 million already. So we are moving, we are looking for good companies, and I think that despite the current macro and microeconomic environment and all the geopolitical discourse around the world, you will be able to find cash. You just need to look in places you wouldn't normally look. So.
Thank you. And I like the allusion to vintage years. That was really that was great. Keenan Williams, why don't you tell us about yourself? You've got a fascinating background, and
thanks.
Take as much time as you need.
Sure. Sorry for the delay. I took Amtrak here, and the first time I've ever taken Amtrak, I should have drove.
Will there be a next time? Will there be a next time?
Lesson learned for next year. So I guess quick background on Resi.
Go take some time. Man.
Sure. I guess I'm the only founder on the table or on the panel. So Resi is the first platform to sell bonds backed by apartment cash flows. So if you think about it, there's a multi-trillion-dollar market of CMBS that sells collateralized mortgages. So in our model, in our mind, there is a large multiple of people that are tenants, not owners of debt. And so there's probably 15 times more cash flow in the world for people that rent apartments than own houses. No one's ever made an asset class against those cash flows. So we do. Our business model takes warehouse facility money from banks. So let's say $300 million. I fund the landlords and developers monthly rent for 3 to 5 years in exchange for me giving them cash flow for 3 to 5 years. Let's say $5 million per building. I own the rights to lease up those apartments. When I lease them up to tenants, as soon as it's cash flowing, I bundle those cash flows, I securitize them, wrap them in a bond, and I sell 100% of the risk to Wall Street investors. So we created the asset class for residential leaseback securities. That's the technical answer for what Resi is. The sexy answer is we created instantaneous rentals. So you can rent an apartment while sitting in this room somewhere in New York City from your phone in 5 minutes. Net. You can find, apply, get a decision, sign a lease with your finger, pay the deposit with your online banking, and take an apartment offline right now. And so instant rent is kind of what we sell as the marketplace model to the world. But my P&L, my enterprise value comes from the fact that I sell securities, bonds backed by cash flows. YC alumni was in Silicon Valley with Sam Altman and Michael Siebel back in 2017, right before he started OpenAI with Elon Musk. 3-time founder and just always building companies. That 15-year stat is absolutely correct. If you're a founder, can you just raise your hand or want to be a founder? This is the hardest time that you will ever see raising capital. So here's how you do it. Stop going to VCs. I know that may not be the sexy thing to say, but they're not going to understand your business in this environment, right? Like inherently, you're talking to somebody that has to return on their book, right? They have to earn a multiple, let's say 2x, right? 3x, sure. So right now, if I have to earn 3x in a very tight market, who am I investing in? Innovation or a step function of growth that's repeatable and forecastable? The latter, right? because it's easy math, right? So if you're doing innovation, don't go to VCs, right? If you're doing something brand new that's never been done before, you're talking to a allocator, someone that has to put capital in places to get a return. If there's no comp for what you've done, if there's not a super huge market with a big established competitor that's Sequoia-backed, you're not going to find an audience often that's really deep dive and willing to take a risk. So right now, it's not just hard for startups to raise, it's hard for innovation to get funding. So don't go to VCs. Go to the myriad of other resources that have cash allocations. So SBICs, venture debt, grants. At this point, accelerators give way more cash than they ever did. 43 North gives 5 companies $1 million. Start from A16Z gives you $1 million. ARC from Sequoia's, their accelerator, $1 million. YC's $500K. So there's a lot of alternative financing routes that everyone can take. If you're doing innovation, I'd stay away from VCs right now. We're closing our Series B, and it's oversubscribed, but it's probably net a B and a C. Usually the B is the hardest round for any startup to raise. But in this environment, doing something oversubscribed and doing the dilution math is pretty incredible to see the lack of intellectual curiosity and more of the focus on the risk mitigation, right? In tough times, people don't want to take big bets. But that's why in tough times, you had Coinbase in 2012. When they came out of YC, who thinks they raised a seed round? They didn't. They went to Union Square Ventures and told Fred Wilson that we have 2 weeks of cash. They had 3 slides. It was all growth charts. Union Square Ventures did $5 million round for Coinbase in 2012. Who did Airbnb's first round out of YC?
Union Square.
Union Square. Did Airbnb get accepted to YC the first time they applied?
No.
Or the second? No. They had to sell cereal boxes. Stripe. Anybody know how long they did everything manually before they actually had automation? First 2 years. So just recognize that in tough environments when cash is low and you have to have alternative sources, that's when the best founders tend to come out. That's my spiel.
Thank you. Miles, talk about the benefits of the venture studio. You have venture studio experience, and talk about the impact that could have in this type of environment. What are the pluses?
Sure.
This type of environment.
So in college, I worked at a venture studio you probably never heard of called Walker Digital that spun out Priceline, and was pretty excited about it. When you have a hit like that, it overwhelms everything else, and they didn't have any other big companies. But I've been very intrigued by the model, and we started a venture studio last year after I'd been inside a number of others as well. We serve as an institutional co-founder. So for someone who's at the stage of deciding who's my co-founder and what idea am I going to work on, we like to be the answer to both. And there are different models of venture studios and how they work. But that's our approach, really focusing on finding the best founders, working together to make sure there's a fit. And then we help with all the work that's building a team, et cetera, as well as putting capital. And the benefits are that we're alternative to VC in terms of source of cash. We're founders. Our team is founders. We've been in startups before, and we do real work, not just advice and introductions, but building alongside. But there are other models as well.
So I founded this company with the studio, with High Alpha in Indianapolis, and it's my 3rd time as a CEO, 1st time as a founder, and I didn't want co-founders, but I wanted partners. And now we've raised our pre-seed, we've raised a seed with venture, pure venture, and the relationship that I find with our co-founders at the studio is very different. And it's very productive, and they are truly aligned. Somebody on the last panel said, make sure that you're truly aligned from an economic standpoint. And the difference in that conversation between, Brad Feld at Foundry, who did our seed, versus Mike Fitzgerald or Scott Dorsey at High Alpha, we are so aligned in terms of what we need to do. And there's a difference between a studio and an accelerator. Those are 2 different models. But for me, the studio was such an accelerator. Literally started on day 1. with a full calendar and a full team that I got to transition into and then out of over time. So I'm a big fan of the studio model. So,
Matt, I'd like to come back to you because you're a VC voice on the panel, and Keenan took this. We'll play a little point counterpoint here in the game show.
Make it worth it.
Yeah. So
I mean, he took Amtrak.
so there's, yeah, I got a joke. I'm not going to say it, but Matt, you have experience with VC, and obviously there is a lot of dry powder out there, and the day will come when these doors open back to where they more open than closed. But in this environment, if somebody's going to come to you, what are in this new calculus you're looking at with the new risk model, the new risk profile, what advice would you give the founders of what they should be mindful of to get through your toll booth?
Well, on that point, I think it's important to stress that it depends what that particular VC invests in. So you have to understand their mandate of these VCs. So if you're a very early stage, there's groups like, as he was mentioning, that you should approach for that capital. If you're more late seed, Series A, Series B, there's different VCs. So we fall more into that late seed, Series A, Series B. For us, we look for companies that obviously have some form of empirical proof of what they've been able to accomplish. They don't necessarily have to be cash flow positive, but they have to show signs that they're headed in that direction. I do think, and the only disagreement I'll say there on who you should approach is I do think that you should talk to VCs because indirectly you might get an introduction to someone that might actually be able to invest in your company. Because don't forget, we also are talking to a number of high net worth individuals. That's who we're trying to get capital from. And so if someone comes to me in their too early stage, I'm going to say, look, I know someone that you should speak to. So it is an advantage to you to actually communicate, and then they have you on their radar. And that's another important thing. It's important to be on these VCs' radars because as you grow, then you can reapproach them and potentially get an investment. But it is challenging. I mean, we see on average, and we're Miami-based, but we see on average, and I'm not sensationalizing this, anywhere from 500 to 1,000 opportunities every month or two. And that's a lot. Now, we're not the Sequoias of the world, but the difference between us and the Sequoias is the Sequoias are more of a passive investor, and we're more active. We want to be the lead investor. So we like to participate in the growth of that company. And we obviously like to introduce those founders to other people that we think would contribute in that growth from a strategic value. So in short, I do think that you should talk to as many VCs as you can just so you're on their radar and potentially get that indirect introduction that could come from meeting those VCs. So.
Excellent.
So I want to jump on this for a second
please do.
to add in that when he says talk to as many VCs as you want, there's this very important place to remember that most founders don't do enough research, and it's also true with public companies, on who they should be talking to as investors. So it's not just stage, it's also what do they invest in? What's their focus area? What does this partner actually care about and what has he done in the past? So you're trying to get to the place where you really have a very clear idea of what motivates that investor to get engaged. And that's when we say like, oh, it's better to come with a warm intro. It's a little bit about, did you do your homework to find an entrepreneur who's been in your space, who understands what you do, and would say that, hey, you ought to talk to this person, right? So it's that part of investor research is really, really critical. So.
And there's plenty of ways to filter every single investor in the world, institutional investor in the world, into your sector and your stage and what people are interested in. I didn't introduce my company. So my company is Cast Iron. As I said, I'm a lifelong entrepreneur with a passion for helping entrepreneurs. And I'm looking at this panel and I'm thinking, and probably this room too, the opportunities that we have collectively to make choices about how we spend our time, how we spend our money, and the careers that we have. That opportunity is not evenly distributed across our economy and across our country and across the world. So I have a passion for helping underserved, underrepresented, and under-resourced and underappreciated entrepreneurs build small businesses. So my company, we're focused in food. So we build a food business management platform that helps small businesses in the food space start, run, and grow their business. It is a passion project. You have to care about small businesses. You have to care about helping people put food on the table by putting food on the table. You have to care about enterprise, B2B SaaS, small business, local, food tech, right? These are all the things you can find investors who will talk to you because that's their job. And one of the things that, as I've gotten older and grayer and raised in 2008, raised in 2013, 15, and 21 and 22, is that the power is on your side. The investors, with all the respect and admiration, need you to make their business work, period. And if you walk in thinking they're going to solve your problems for you, like, that's never going to happen. I've never seen it happen, and it won't happen. In fact, if you ask them to solve your problems, they're going to run the other way, because that's not the job. And so I don't think there's ever a bad time to build a good business. And when I hear you talk about your business, that's a great business in any economy, probably. I mean, I don't know, but like, that's right. And so, like, there's no secret to that. That's like fundamental, understanding your customer, understanding the market, understanding a problem and the pain point. And then there's like a matching process that's very, very real. Like, I think you should talk to as many VCs as you possibly can, just because you might hear something you didn't know. Right?
Let's talk about a little bit how you do that. So one of the things that's so interesting is you hear people say, like, well, you should go socialize the deal. What the hell does that mean, right? When I said this thing about people being fearless, it's that you're actually always fundraising, right? You're going out and you're meeting people, and you might have a meeting with a customer in San Francisco, and you're going to set a couple of meetings to sit down with people and talk to them about what you're doing and get their best perspective on what you're doing. And then they know you, and they know when you're coming back. But in that moment, you probably are not asking them for money. But it's one of the things about that is people sort of think like, well, I'm going to start my raise in June, so I'll go out in May and start socializing. And then like 2 weeks later, I'll call them up and I'll say, I'm raising money now. But then you haven't built a relationship. They haven't really had a chance to get to know what you're doing and see you make progress as you go. And that's really what we're doing when we're talking to you.
Good. Can I add 2 things?
Yeah, totally.
All right. So everything you've heard is spot on. The one thing you haven't heard is you really have to be a pretty thorough founder at this stage, right? The free and easy money is gone. If you didn't raise in 2020 or 2021, it's a wrap. Right, like they call them ZIRP founders, zero interest rate policy founders. So they raised when money was cheap. When money was cheap, it was easy because VCs took a ton of risk. And then in 2022, they paid for it, and their books had real issues. Right, so in 23, they're allocating, like the most trepid walks on water possible because failure is what they've seen for the last 18 months. And so for them, finding wins is big. So what you're hearing is right. You do have to have relationships. Here's how you build relationships. If you have a pen and paper, you surely write this down. Do not talk to a VC until you've actually put significant work into the product being used by a customer. Does that make sense? Not an idea of the product. The product's built, a customer's using it. Doesn't have to have cash flow, but a user is using it. That's number one. Number two, another point that was made that was incredibly accurate, be spot on with who you're talking to. Like at this point in time, when investors are not allocating graciously, they are so sensitive to how they're using their time because they're trying to catch their first win, right? So if I cast a small piece of bait and I keep getting these really shitty small fish, do you think I'm gonna stay in that spot? No. So if you keep going to investors and just simply talking about your idea and what you're doing, do you think they're going to refer you to someone else? Yes or no? No. The only way you're going to get referred is actual production. So right now at the seed stage, most investors want to see T12 revenue. Do you know what that is? Who knows what T12 revenue is? What is T12 revenue?
Trailing 12.
Okay. What does trailing 12 revenue mean?
Past 12 months of revenue.
And if you don't have a T12, should you be talking to certain investors that care about revenue?
Oh, no.
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 And how many investors do you think about revenue right now?
Everyone.
There you go. So with that said, like I cannot make this any more clear. You're wasting your time If you think you can start having conversations for conversation's sake, you have to be incredibly intentional to build relationships with a purpose. So I'm not raising right now. I'm happy to tell you about what I'm doing, but I'm more interested in learning about you. Why? Is because doing your diligence on investors is 10x the return it's ever been. Finding the specificity of who invests in your space at your stage with a matching thesis and has done so in their portfolio is a match made in heaven. The majority have not. And so it's on you to do that research. They're not going to do that research for you, right? What they'll do is they'll entertain you when you walk up, and they'll make a little mark that I will never talk to that founder again. And if I see that deck, I will shit on that deck. Right? Like it's real. And so I think what's best is don't fall into any more of that market hype that drove the nomenclature for the last 3 years. At this point, being a founder is like being a Yale student. Did you get into Yale by making Fs? No. So you shouldn't be moving with VCs or in the market like an F student, right? Treat the game today like you're trying to make an A+.
Could you just say 3 things that you would tell them once you do all your research? What are the things that you would in your research? So you're doing your research on a VC or somebody. What are the 3 things? Just law of 3. What are the 3 things you research?
So assuming your research is they fit the criteria, right? So the first thing is you want to know, are you actually allocating from a fund today or no? Right? Are you actually investing? Are you putting money out to the market? Is the vintage of your fund closed? Is it dated? Are you raising right now? Or are you actually deploying? Right? If someone is not deploying, don't waste your time. Right? They'll be happy to have the conversation because they're building up a cadre of names to call when they do have a fund. But if they don't have one right now and you're in need of capital, next. So after you ask if they're actually deploying, number 2 is, can you give me some confirmation or some context as to around what your thesis is today? Right? What you see online is not where they're investing at today. That was written 2 years ago. Right? It's almost all wrong. Right? And VCs are not like updating websites like they update resumes. Okay? So be really, really clear. Like, are you actively in my space at this stage? And then the third thing is, okay, you're raising money, you're deploying in this area. What exactly are you looking for on the base case? Right? Like, ideas aren't getting backed unless you're a 4-time founder with 3 exits. Right? So are you looking at pre-product or post-product, pre-revenue or post-revenue, and then what's the level? So those are the 3 things that actually dictate should you have an engaging conversation with that person or not. And even if all 3 are a yes, that still doesn't mean that's a right fit because they may not like your business model. They may have 5 deals similar, right? Like NVIDIA, everyone knows NVIDIA is about to hit $1 trillion, right? They're about to join the T Club. When Sequoia wrote the check, guess why they wrote the check? Do you think because the founder of NVIDIA pitched? The founder of NVIDIA got a what to get the Sequoia money? He got a referral, right? When Coinbase raised their A from Union Square Ventures, it's because Paul Graham called and made a call, right? So at this point in time, real deals are getting done by referrals. So the relationship social currency is worth more than a cash dollar. So if you take one thing away from here, you better take away, not that it's time to raise, it's time to build equity positions in my VC relationships, which means I'm figuring out who exactly I should be talking to a year out, what I should be bringing to the table when they're ready to talk, and then how I'm going to position myself best to do that. Anything intermediate is a waste of your time.
I'll add to it. I don't know what we're talking about, but should I just keep going?
You're the panel, so I
Taking control.
I mean, we're at Yale. Do I need to coach up smart people?
Oh, we turned the panel in how to raise money, I guess.
Yeah.
That we're supposed to do.
Yeah.
It's a model for supporting a fund.
So one thing you didn't say is about building relationships with founders. So the best introduction you can get to an investor is from a successful founder in their portfolio who gives you a strong reference.
50-50.
You don't agree?
50-50, no.
I think it is incredibly powerful because if a VC calls them another investor in the company, like Paul Graham calling Union Square, he's talking up his own book. So it's going to be taken with a grain of salt because he already owns equity that he may be trying to increase the value of. A founder who doesn't have a stake in your business, who says, this is someone I've watched, I've gotten to know, and they're executing, I'm impressed with them. That is a very strong endorsement. It's another route in. And I would recommend that is a value in. Well, one of the values of building founder relationships.
Yeah. No, but back channeling through founders is critical. The only reason why I say 50-50 is because even though Paul Graham is selling his book, he's given unicorns and exits to Union Square Ventures. So that call still holds weight, right? Because I made you money, right? People listen to people that made them money before.
Yeah, but that's lazy.
No.
I think it's lazy, and it's great if you have it.
Yeah.
It's great if you can make that happen.
Yeah.
But how many thousands, conservatively, of entrepreneurs are there who don't know Paul Graham?
Well,
who don't know Fred
less
Wilson,
about.
who don't know Claudia.
I'm
right?
giving a one-off.
Everyone knows Claudia.
It's way more about where you're a top performer in your batch, right? Like it's less about Paul Graham. You can go through Techstars. You can go through any accelerator. If you're the shit, the MD is going to vouch for you. And I think that's really what it comes down to. It's not about I know a specific name. It's I'm an incredible founder that's not performative. I'm substantive. So someone takes a bet.
Some of the best investors I've seen go find the deals and go find the entrepreneurs.
Fair, but we're talking about the time period. Like, that's not universal. That's when things are good. When things are horrible, the best unicorns that come out of the last 20 years, like, so have you read Super Founders?
No.
All right, so Super Founders came out 18 months ago. First empirical study ever done on unicorns, ever. I recommend every single one of you read this book. It's written by a VC, right? So he looked at the last 20 years, every billionaire founder, what was the synchronicity between all of them? And he wrote like a 200-page book on it, okay? The majority of the best companies that didn't just touch the valuation of a B, but actually had sustaining power, got the IPO, got the exit and growth, came out of downturns, right? Downturns historically produce the best sustaining companies because they have to be profitable, they have to actually have growth, right?
So we're in that place.
But
That's where we are right now.
We're in that place. But guess what happens when you're in tough times? It's hard to be sexy and attractive, right? So you actually need the vouch. The other hard part is, wait. The other hard part is, if I call a founder in a book, I have no idea what that founder is telling me. Because here's how it goes. Hey, bud, you got invested in by so-and-so capital. Yeah. How you doing? Oh, we're crushing it.
Yeah.
We're all right. Yeah, we're ripping it. You're 3 months away from running out of cash, and you will never tell your buddy that. He's not going to go tell the MD that made the partner that made the decision, because the partner's like, why did I think about you? You're 3 months out of cash. And so like it's hard to find a successful founder that's actually got the pedigree with their MD and partner to make the vouch happen. It's easier for someone of ilk.
Because they're a successful founder doesn't mean that you are connected to them.
I have
But
a,
let me, wait, I want to jump in with
Yeah.
a totally different perspective. Because one of the things you said is
This is a time when VCs are not going out and looking for things. So let me.
They're not. I'm saying
Yeah.
they should be.
Well, we
That's
should
what
be.
you do.
And so let me tell you a little bit about how I think about that, because that's part of my job. I spend a lot
ripping
of
it here.
time
We're ripping it here,
sourcing.
It's the best panel.
I think about it two ways. I really want that warm referral because I know the people that I've worked with, and that hard work and those relationships are usually born of things like we worked on a company together early that we both believed in, and even if I didn't get the deal done, one of us got it done, and it's been working. Or it hit a rough spot and they asked for help and we helped each other. Or we were in the boardroom and there was a rough spot and we worked through it together. And so we really have a lot of trust. So that's why those warm referrals are so valuable, right, to me. But I also know that what you said, the best stuff is born now. But if I like to invest in deep tech or enterprise and I need to see that place where I'm looking for a global game changer and they have to be developing some traction. If I wait until they have the traction, I'm not necessarily going to be in the deal. So I actually spend a lot of time trying to find the people who are sort of a year out,
yeah,
a year and a half out from where I could really invest. And then I'm getting to know them, or they're spinning out of MIT, or maybe they're spinning out of Yale. And I'm going to follow what happens and say, I'm either with this or I'm not with this.
This is a
But that
segue to my
depends
next
on
question. So
everything
thank
about
you.
how you form your team and get moving.
So Matt, I want you to, you talked about something earlier about your experience in the Middle East and how long it takes to develop relationships. And you've got I think some particularly good insights into just the hard work and complexity of developing relationships, and talk about that and this whole notion.
So two quick things, just really on that last point real quick is I mentioned the inflow of companies that come into our firm that we see. Do you know how many of those that actually get meetings? It's less than 0.5%, because there's just not enough time to figure out which ones we want to look at. The ones we actually it's the referrals that we're going, or we're out. We are one of the firms that actually goes and looks for these firms. So anyway, going to the Middle East part, So I started going to the Middle East right after Yale. I got my MBA here, and I started going around like 2015-ish, 16. And it wasn't what it is now. Now it's just everyone's running there because there's so much cash. And instead of deploying that capital outside, a lot of it's being deployed inside their countries, particularly Saudi, which is pouring trillions into its ecosystem. But with that being said, building relationships out there is really tricky because, you know, it's very easy to, it's kind of like the best way to describe it, it's like a trust thing. And as many of you know, trust is very hard to gain and it's very easy to lose. And then here's a very quick story of the Middle East. So I was out there fundraising for film financing, Hollywood films, big films. So we were working on House of Gucci, Ghostbusters, what else were we doing? Babylon that just came out was a complete bomb. Lost everything on that. 65 lost everything on that. But House of Gucci did well. Ghostbusters did well. And now we have Gladiator 2 that we're working on. But that allowed me to get in doors I wouldn't normally get into, just from talking about, because everybody wanted to talk about movies. And so I started, you know, going into these with sovereign funds at the investment committee level that just want to talk about it. Nobody wanted to invest in that asset class because it was too risky. Then you start talking about venture, which is just equally as risky. But that one, all of a sudden, they're like, well, you know, you're kind of it's not really something that we're interested in at this time because it's such a risky environment, et cetera, et cetera. But what I started finding is just through having these conversations and building that trust, then all of a sudden they started asking me more questions about the venture or, you know, tell us about the companies you're looking at. But that took years. Like I was going there for 7+ years trying to build these relationships. And just now, do I have enough trust with them where I can bring them a good company? Like your company, take an example. I would love to be able to say, you know, meet this guy. He's got an incredible company. I'm sure you're already talking to people out there. But that's an example of someone that just from sitting here, listening to the way he talks, the energy, the enthusiasm, I already know just from this moment that this is someone that I feel pretty comfortable making an intro to these guys out there. Now, if I introduce someone that I might have some questions about, I could lose that relationship with that Middle Eastern component just like that. And that's something you have to also take into consideration is that who you introduce, who you engage, it's a reflection of you, and it's a reflection of your company as well. So that's another tricky component about fundraising.
Great. Thank you.
We're
going to open up to the audience after this.
1,000% agree with you and understand. The challenging point I'm trying to raise, maybe not effectively, is, look, I'm 51, 3-time CEO, 2 exits in my first time. I have no problem getting introductions to investors. They call me, right? More than they should with where my business is today. And my business is focused on today on thousands of micro small businesses with remarkably talented entrepreneurs who are never going to raise venture. It's not their goal, but it's emblematic of entrepreneurship and opportunity. And I wonder about that access to capital, and I wonder about the how equitable that can be when we're gatekeeping based on who we know and what accelerator we go through and how we make that happen. And so I would more broadly challenge the institution of venture and how we can bring more access to opportunity to more people.
So you're going to have the last word, Jennifer, and then we're going to open up the audience for questions. I want you to talk about being a woman in the space. I know Claudia Reuter wrote the book on it. Yes, you can do this. And Claudia's at Yale. So for you female founders, that's the book you want to read. Go ahead, Jennifer.
So I've been an investor basically since 1996, and I still don't truly believe that I can do this. So I'll just put it out there that you need to know that imposter syndrome runs like big and huge, especially for women. So I have 2 passions about this. One, I'm really blessed to work with a fund with a woman who is Asian and a VC, double minority since the 1980s, which makes her truly a rarity. She was a founder of Vertex Investments and then went on to found her own fund, which is the roots of iGlobe in 1999. So I'm blessed to have found her. I wish I had found her when I was in my 20s. So I'm very dedicated personally to 2 things. One is changing the gap table, which is the lack of women women check writers represented on the cap tables and women VCs represented on the cap tables, because I believe that when we're writing the checks, then we'll have more power to make change. And I also think the other thing is we've got to open the aperture. Like when you say we go out and seek, if we want to find the best women investors and the best underrepresented founders, we actually have to actively seek. And so I'll give a little shtick for Techstars. I really appreciate their vision and their mission of what they're trying to do, going globally to be the largest accelerator funder in the world, to create that diversity and create that open aperture. I think it's critical. And I think it's because we have big challenges. And the best thing about entrepreneurship is the smartest and the best people who are passionate about solving big problems are the ones who will dedicate themselves to doing it. So I'll leave it there and you can open to questions.
Excellent answer. You hold the mic because the questions are going to come to you from you. So who has a question? Go ahead.
So a question that I have is, there was a lot of talk about VCs. I was wondering if all the recommendations and information that was given also generally applies to angel investors, or should different rules be used for that? Well, how big is the disparity and how you should act with it?
Let me take a stab at that and then I'll hand off the mic. They do apply in terms of really researching what the angel cares about and what they're interested in. Like all of those pieces and relationship building apply. I think one thing about angels that's really interesting is many recently really want like the VC-like return, and they want to see, they're looking for the things that can have that asymptotic growth. Is that the right word? I'm having a math moment. But thank you.
Yeah, hockey stick.
Yeah, the hockey stick. Okay, but there's also a number of people who, depending on what you care about, depending on what you're building, depending on the kind of cash flow you'll deliver and the exit opportunities, can be very happy if you're going to be a strong linear grower, right? So it's about finding what they care about and do they care about what you're investing in.
A quick thing on that point. So we have a company called Better, B-E-T-R. It's a Joey Levy, a Theo Fellow, with Jake Paul, the YouTube boxer influencer. The company's doing tremendous. It's currently around a $300 million valuation. It's going to be a $500 million relatively soon. I've gone to a number of individual investors, high net worth people, to talk about getting capital for that firm because they're raising around. And a lot of them didn't do deep dive due diligence on this. They just love the story. They love the people who are a part of it. They wanted to be associated with it. They like gambling, et cetera, et cetera. So it's a unique way to raise capital. But what I found is that to her point, is that if it's a subject that they're excited about, that investor, knowing your investor, then there's a higher probability that they're going to do a little bit of a quicker due diligence process on it and want to allocate capital to that company. So.
Let's talk about one specific thing about, like, let's say you get the super high net worth investor. In today's environment, do be very, very conscious about the valuation. Like, we've just come through this place where people are chasing, as a founder, get me the highest valuation that I can get. But then you can be like, out over your skis. Did you hear me? Out over your skis?
Yeah.
You don't really want to be out over your skis. So sometimes you can have a very big mismatch of what a high net worth person thinks the company is worth, and that can put you at odds if you end up, growing in a way that you need to go and find a venture investor. So make sure you really understand where the market is at for your venture today, and be in line, right? Don't be out of spec.
Yes, I think there's differences in. The last time I raised from angels was 15 years ago, and it was a different market and a different world. So I'm not sure I'm not going to talk just to talk. I'll pass it on.
Another question? Go ahead, sir.
Yeah, I'm just curious to follow on what you said about Better, in particular talking about and valuation, because I kind of picked up and I was curious. You're talking about a company that has a $300 million market capitalization. It's pretty early, right?
Relatively early, yeah.
Relatively early, and it seems, I just did a quick look on my phone. It looks like they're just getting started. And you have a guy like, what's his name, Jake Paul? Yeah, he's obviously got the money to put his own assets in. I'm curious how you think about the tension point of when something's got a monster valuation, it's early stage, and you have a guy looking to raise outside capital. He can clearly do it himself. How do you kind of navigate the tension of? I mean,
So that's a very good question. It's a little tricky because they have Jake Paul has with this guy Jeffrey Wu. They have their own venture capital firm, and Jake is more of a reflection of he's kind of the brand side of it. He gets access to high net worth individuals. We went to Saudi Arabia for his fight, and there we are with Mike Tyson and all these people because of him. With that being said, though, you have to manage that personality, but you also can leverage it. So he's got now Better, even though it's a gaming app, it's actually much bigger. So they have a Better combat division. It's quickly getting into new states left and right. So I can't say it yet, but there's a number of states that are coming. They're getting onboarded as we speak. And then there's another component of social media because he has something called the BS report. And they all kind of fall under this umbrella. But we are very careful about, because we're one of the lead investors, we are the lead investor, we're very careful about how we engage with Jake. Because your point is you have to deal with that personality as well. But Joey Levy, the Thiel Fellow, he is a rock star. He's the one that's kind of driving the strategic direction of the firm. I have a lot of faith in him. He's, he himself is an entrepreneur from prior companies he's had as well. So he's one of the people that we follow what he's doing, and then we support, as the best we can to support the growth of the company.
We got to hang out with you.
First, it's more of a follow-up comment on that, and then a question. But follow-up comment is, I was an investor, and I'm second company founder. When you're using your own money, right, you're almost too conservative on it, and you want other investors to give you the money because you can actually make smarter risks and not be fearful about every dime and nickel that you're doing. So I think, and also having someone else validate it by saying, hey, I believe in what you're doing too, and put that money in, and the assets they bring, I think, are huge. So that's my POV on that. My question back to the panel now is that this is a very different environment. I agree on the looking for the right investors, outside of the box investors, not your typical route of going about it. At the end of the day, I think it's like, finding customers. And so I think what's the best way for startups to really get in the door to find customers? Because I think ultimately then the capital that you need will come either through that customer or through alternative investors.
Do you want to go on that?
Yeah, for sure.
Okay, so I'll give you feedback that's industry agnostic, right? Because that answer could be incredibly convoluted relative to the vertical. So super high level, things to avoid. Don't do freemium right now. Charge from the beginning, right? Validate your product by making people pay from the door, okay? The conversion cost and timeline to go take somebody from free to paid is incredibly hard. That's like saying, hey, we're boyfriend and girlfriend. 2 years later, no, we're not. But then the next day, okay, you want to go back together? Right? Like no one actually comes back from that like massive drop off and change easily. 2, you really want to focus on your pricing strategy. So agnostic to where you start, your focus should also be how do I grow it, right? So from a cost basis, am I doing value-based pricing? Am I doing 2 tiers and expand to 3? Am I A/B testing out the wazoo to validate what my price should be? So number 3 is A/B testing. Like you need to make everything a data-oriented decision when it comes to pricing. And then the 4th thing, I think, when it comes to finding a customer is leverage every mechanism that has a low CAC. Every mechanism, right? So like do things that don't scale is so meaningful right now. If I am selling SaaS to compete with Toast to coffee shops, I should not think of digital only. I should go out into New Haven and touch every single coffee shop owner in a 30-mile radius and get friends to do it too. I should be able to get 100 customers manually before I even think about optimizing for a digital strategy, right? Like let my CAC initially be my time, not my dollars out the door. And I think if I'm a VC, if I don't hear you being creative around customer acquisition, I don't care how great your product is today, it can't scale, right? Because you're not an operator, right? You're someone that got it to a point and you think you can sell the sizzle from there. And I think the last thing about customers is you have to talk to them, right? Like I don't want to get on a YC soapbox, but this is what they beat into our heads every day from day one. you have to talk to your customers. If your data-oriented decisions are coming from their feedback, not your gut, you're going the right direction.
Yeah, the part that I would add to that is when you're first starting out and you're first getting your customer number 1 through 5, you can start with a conversation, you can start with an inquiry and question, classic design thinking, go outside and ask open-ended questions to understand. But what I would recommend different than classic design thinking is try to get to a close in every conversation. So if you're getting 30 minutes of someone's time to understand their problem, and you probably don't want to pay them or give them too much incentive. It's like the fact that they will spend their time for free means they care, and it's probably a problem that they care about. As you're getting towards the end of that, close them on something. Can I follow up with you? Can I add you to my email list? Et cetera, and escalate it. If they're nodding along, like, would you sign a letter saying you like it? Would you pay for it? Oh, would you pay $100 for it? Would you pay $500? Oh, I got Stripe in my pocket. Will you do it? Right? Like, just keep going. And through that inquiry, you'll find, like, what is the profile of the customer? What are the pain points? And it'll help you hone in. I don't know if you were talking about, like, the very first customers.
Yeah, pretty much.
I'm a founder of a climate tech company. We actually pitched today in the climate track. And I'm curious, I didn't know if this panel was going to be about this, but maybe talk a little bit more about alternatives to VC, maybe tapping like accelerators, grant funding, debt financing. Just tell me a little bit more about that and other founders or potential founders.
Sure. So I founded this company with a studio, and I got it through warm intro. So, but I'll represent that perspective here now, which is there are accelerators and studios that have specific theses. Is that right?
Try word.
Thanks. Asymptotic.
But you went to Yale here, so
Yeah, I couldn't get in, but my niece did. There she is. But
Wait, where are you?
You're at the train station.
Still, somewhere along next stop, Old Saybrook.
Track 4.
So I think it comes back to doing the research on the studios and the accelerators that care about your climate tech, that are particularly looking at that. I'd also look at strategics as interesting. I mean, I'm not a fan of strategics on your cap table, but the one thing we're all talking about how great it is to raise money and how we can go do that, but it's fucking hard. And your job as a founder is to get that next round and to get that money almost at whatever it takes, almost. And so I would look at strategics also in tough times.
So I love one time I walked into Katie Ray from the Engine talking about customer-based financing, by which she meant revenue. So that's still number one. Try to get this person to pay for whatever it is. For climate, the other thing that I would say is, I think actually across multiple disciplines, there are many, many, many government grants. So if you do run into it and you think you can apply, the SBIR program is an amazing program, and the NSF is in there, and the DOD is in there, and the National Health Institute is in there, and the Department of Education, and it really just depends. There's a lovely website called opengrants.org, which is a 16Z-backed company that's made a much easier to use interface to look for all sorts of both the government SBIR grants, but also grants coming from foundations and other nonprofits for your business, which is another really interesting place to go and look. And then if you have revenue, there's been the advent of a number of sort of revenue-based financing companies that have specialty disciplines for different verticals. So things like Wayflyer if you're building an e-commerce company, or CapChase if you're SaaS-based or enterprise software.
Just on that quick point, and this is thinking outside the box, and many in here won't consider it, but if you're open to it and you don't have to be in the United States, you can go to the Middle East, you can go to Abu Dhabi, you can go to Riyadh, and they provide a lot of incentives for people to come and incubate their companies there. There's an Abu Dhabi investment office that provides financing for that. They will give you cash to build your company there. And it's a beautiful environment. I think there's a stigma that's attached with it that's been there, but it's not what you think. It's actually an incredible place to live. It's incredibly safe, and they will give you the tools to help build your company. And the cash is all sitting there too for that growth. So keep that on your radar.
I would just add, for if you've got a European background, the EU has done a number of really great grants for startup founders. I think one of the challenges is think through, before you even start, what kind of company do I want to be?